So this set of lectures is about macroeconomic policy in an international context, but to connect that to what you may have learned in an introductory macroeconomics course, I want to talk a little bit about closed economy, Keynesian approaches. Again, this is the Keynesian, not the neoclassical approach. And just as a review, we've got these key aggregate demand tools that in a Keynesian world can be used to increase aggregate demand. Tax policy, so that you might want to cut taxes in order to increase aggregate demand, may increase government spending on goods and services to increase aggregate demand, or you can use monetary policy. Now these two I think are relatively well known, but I want to review at least 4 ways in which the government can use, or a central bank can operate monetary policy, especially to increase the money supply. They can print money, physically print money and circulate it. They can have an open market operation, which is a term used in the United States for the central bank, the Federal Reserve, buying or selling domestic bonds and giving out money, so that if the government buys bonds, say treasuries, and writes a check for it, you've increased the money in circulation by buying bonds. In the early, after the Great Recession in 2009, the Federal Reserve did what was called quantitative easing. That quantitative easing was open market operations, where the Federal Reserve was buying bonds, increasing the holdings in the balance sheet by increasing the amount of, and thereby increasing the money in circulation. Okay. Another traditional way of doing it is trying to influence the short-term interest rates, which may spill over into interest rates for the economy as a whole. That's probably the most traditional way that the U.S. does it. You can also change the reserve requirements of the amount of funds that are held in banks, in commercial banks. If you lower the reserve requirements, that means there are more loanable funds and you have more money in circulation. So that's just a quick review of these policies. Now, what I'd like to do now is to set about a chain of reactions to various policies on a number of different variables. Now, I'm going to do this in a very heuristic and general way without using a formal economic model, but I think you'll see where we're going with this. So first we're going to take a look at the policy. We're going to then look at what happens to the aggregate demand. We'll then look at what happens to the amount of economic activity in the economy. We're going to look at how that increase in aggregate demand affects the demand for money. Okay, money being the money demand being how much cash citizens need in order to undertake transactions they'd like to do, and that will affect the interest rates. Now again, if you recall, we had this view of aggregate demand, aggregate supply in the Keynesian world, where we had aggregate supply, aggregate demand. So basically you're talking about some sort of policy that will increase aggregate demand. Okay, that's the simple graphical version of this. Okay, well I should read that down. Okay, so first let's talk about a tax cut. So if taxes are reduced, I'm going to write this in the directions in blue. So if taxes are reduced, that means that there is going to be more income held by domestic residents who can then spend it on goods and services. Okay, so the increase in disposable income will increase aggregate demand. Okay, will increase the amount of output, so GDP, will rise as a consequence. Now, when people have more income and they're buying more stuff, there's going to be an increase in the demand for the existing stock of cash in the economy. Now, I want you to make sure that you distinguish between money and income. Money is the cash and demand deposits, checking account. That's not income. So a decrease in taxes increases income, which then will increase disposable income, which will increase the demand for the existing stock of cash in the economy. We haven't changed the money supply. We've increased money demand. Okay, the increase in demand for money will increase interest rates. Okay, so a tax cut will result in GDP going up and interest rates rising. Okay? Now, let's imagine that instead of a decrease in taxes, that we had government spending increase. So you start infrastructure projects, you build highways, you have various ways in which the government is demanding more goods and services. That increases aggregate demand. More demand results in a higher level of GDP. Money demand increases for the same reasons that we talked about before, and you have an interest rate increase. So, excuse me, these two fiscal policies, okay, so tax policy and government spending policy are fiscal policies, will both result in increased aggregate demand, increased interest rates. Very similar actions for these two in the Keynesian world because they both increase aggregate demand. Okay, so that's the closed economy version of fiscal policy. And actually, just to make this clear, let's call this A, and monetary policy is B. Now we have an increase in the money supply, say to get out of a recession. The Federal Reserve Board or another country's central bank prints money, buys bonds, decreases short-term interest rates, reduces reserve requirements. All of these things will increase aggregate demand. But the increase in supply of domestic currency will end up resulting in, okay, so an increase in money supply will end up decreasing interest rates. Okay? These decreasing interest rates also increase aggregate demand. Why? Because it's cheaper to get a loan for a car, it's cheaper to buy a house, it's cheaper to borrow money to expand a business. All of these things, these lowered interest rates, also increase aggregate demand. So, in this Keynesian world, fiscal policy, i.e. tax and government expansionary tax policy and government spending policy, increases output. Monetary expansion, a monetary stimulus, expands, I forgot to mention that both of these result in higher overall GDP. So monetary expansion results in an increase in aggregate demand. So those are all effective aggregate demand policies in this closed economy world. But here is the critical difference between these things, which we're going to see in a number of different contexts. And you really want to get this solidified in your mind. Expansionary fiscal policy will tend to raise interest rates. Expansionary monetary policy will tend to lower interest rates. These two things go in opposite directions. Now, in the closed economy, that's relatively unimportant. When we have an open economy, these different pressures on the interest rates are going to affect the capital flow between two countries. As we talked about when we discussed uncovered interest parity, covered interest parity, the factor of capital mobility across countries, a decrease in interest rate or an increase in interest rate will have radically different effects on the pressures on the exchange rate, which are going to make the domestic policy or the closed economy options and the open economy options very different. But just to summarize this, in a closed economy setup, which is what most people did in an introductory macro course, these Keynesian policies in the short run are all effective. They have different effects on the interest rate, but they both end up with higher GDP. We're going to see in the next important section of this course how in a closed economy or an open economy context it's not quite so simple. Okay, so if you want to take a look at other videos relevant to international economics, take a look at that YouTube video. Sorry. Thank you.